Welcome to The Explainer. Today, we're diving into a genuinely fascinating story of market resilience and strategic adaptation. We're looking closely at Mission Produce and specifically how they managed to navigate some incredibly volatile commodity pricing in their Q1 2026 financial earnings report. If you've ever wondered how a global agricultural powerhouse can actually turn falling prices into rising profits, well, you're in exactly the right place.
Here's our roadmap for today's deep dive. 1. A strong Q1 start. 2. Avocado price versus volume. 3. A segment-by-segment breakdown. 4. The massive Calavo growers acquisition. And 5. Future industry outlook. Let's just get right to it.
Okay, Section 1, a strong Q1 start, setting the stage for fiscal 2026.
Now, Mission Produce is already widely known as a global leader in sourcing, producing, and distributing fresh Hass avocados. But recently, they dropped a deeply data-rich Q1 report that tells a pretty remarkable story of corporate resilience. In agriculture, you are constantly at the mercy of Mother Nature and unpredictable market forces. But this report, it shows us exactly how a company can build a serious buffer against all that unpredictability.
Right out of the gate, we're hit with this very concrete success metric, an adjusted EBITDA of $18.5 million. That's a 5% increase compared to the same period last year. So why does this matter? Well, it's absolutely crucial because they achieved this profit growth despite some major market headwinds. In fact, their overall total revenue for the quarter actually dropped by 17% to $278.6 million. Growing your core earnings while your top-line revenue shrinks, that is a classic textbook sign of brutal operational efficiency.
Moving on to Section 2. Avocado price versus volume, the economic tension of Q1. This brings us to the core economic tug-of-war of the entire quarter.
And this slide brilliantly illustrates the situation. We saw a massive 30% decrease in the per-unit avocado sales price, dropping down to an average of just $1.22 per pound. Why? Because a significantly higher yield from Mexico essentially flooded the market. However, Mission didn't just sit back. They capitalized on this by pushing a 14% surge in total avocado volume sold, moving a staggering 181.5 million pounds of fruit.
So here's the real kicker. By managing this massive surge in volume so efficiently, they didn't just tread water. They actually increased their gross margin by 190 basis points, bringing it up to 11.3% of revenue. Honestly, it's genuinely impressive that they took a market condition that could have completely crushed their margins, plummeting prices, and used their massive distribution scale to actually improve their profitability profile.
Mission CEO Steve Barnard perfectly summarizes the strategy behind these numbers. He noted that industry pricing simply normalized from the really elevated levels we saw last year. He said, "We're focusing on the two levers that drive long-term value, volume growth and per-unit margin management." This quote is essential, really, because it demonstrates how disciplined, operational focus creates sustainable value, completely regardless of whether the per-unit price of an avocado is breaking records or just returning to normal.
All right, Section 3, segment-by-segment breakdown, where the revenue actually comes from. Let's see how this all builds across Mission's different business lines.
What's really interesting here is the sheer dominance of the avocado segment. When we look at Q1 sales by type, avocados generated the vast majority of total net sales at $220.9 million. Now, while they have successfully diversified into blueberries, which brought in a solid $40.8 million, and mangoes at $12.9 million, Mission Produce is still at its absolute heart an undisputed avocado powerhouse. I mean, considering how much guacamole we all eat on game days, it makes perfect sense, right?
Breaking down the adjusted EBITDA by business segment gives us an even clearer picture. We can see the marketing and distribution segment drove the bulk of the growth, jumping up 33% from $9.7 million to $12.9 million. International farming also saw a really healthy bump, moving from $1.8 million to $2.3 million. The company attributes this directly to better pack house utilization. Basically, they're getting more and more efficient at handling the actual fruit they grow.
However, we should note it wasn't a perfect quarter across the board. The blueberry segment faced some localized agricultural challenges. They experienced lower per-acre yields on their farms. And as you might know, in farming, when your land produces less fruit, the cost to produce each individual unit goes up. It's just simple math. This fundamental agricultural dynamic drove up per-unit production costs and effectively cut the blueberry segment's adjusted EBITDA almost in half, bringing it down to $3.3 million from $6.2 million the prior year.
Okay, Section 4, the Calavo growers acquisition, expanding the platform.
Now we're going to zoom out to look at a massive strategic move that hovered over the entire Q1 balance sheet.
This timeline maps out the life cycle of the merger. The agreement was officially announced on January 14, 2026, and the integration planning is already well underway. They expect the transaction to officially close by the third fiscal quarter of 2026, subject to, the usual regulatory green lights and shareholder approvals.
And guys, this is a massive deal. Under the terms of the agreement, Calavo's stockholders are slated to receive $14.85 in cash, plus a fraction, specifically 0.9790 shares of Mission stock for each Calavo share they currently own. At the time of the announcement, this brought the estimated transaction value to a cool $490 million. It's a bold, decisive financial commitment that signals a major evolution for Mission Produce.
But you might be wondering, why spend nearly $500 million? Well, according to Mission's president and CEO-designate John Pawlowski, the strategic rationale is really threefold. First, they anticipate unlocking at least $25 million in annual synergies. Second, it expands their supply reliability across crucial growing regions like Mexico and California. But perhaps most importantly, it grants Mission Produce immediate entry into the high-growth prepared foods sector. Think about it. They aren't just selling raw avocados anymore. They're going to be selling ready-to-eat Calavo products like guacamole and salsas right off the shelf.
Finally, Section 5, Future Industry Outlook, navigating the rest of 2026. Let's look ahead at the forward-looking expectations. So for Q2, expect current market dynamics to largely hold steady. We're looking at industry avocado volumes increasing another 10 to 15%, while pricing remains 30 to 35% lower year over year due to those continuing high supply conditions. Over in the blueberry segment, they're looking at an accelerated Peruvian harvest, but they do expect profitability to continue to be impacted by lower projected yields per hectare. Finally, they've pegged their full-year capital expenditure at approximately $40 million to continue funding their global infrastructure.
As we wrap up this explainer, I really want you to consider this final thought. Mission Produce has completely proven they can master the raw commodity market, squeezing out margin improvements even when prices plummet by 30%. But with the expected closing of this massive $490 million merger on the horizon, how might Mission Produce's entry reshape the entire competitive landscape of the prepared food sector? It is a whole new ballgame, and for sure, we will be watching closely. Thanks for joining me on this deep dive, and keep learning.